Warm welcome to everybody. My BIA friends, friends from ETMA, Marcia, Maharashtra Chamber of Commerce, Industries and Agriculture, NIIE and Mukesh Kalraji from Delhi, RATA, MSME and Startup Forum from Banaras, and FPTA. Thank you everybody for joining in for this first in the series of investors in startup space. And we'd like to, thank Nitesh Aggarwal ji for consenting and Satish Singh ji for arranging this. Like to hand over to Neville Bhai for introducing Nitesh Bhai.
Thank you, Sanjay Bhai. Welcome, Nitesh ji. A small introduction of Mr. Nitesh Aggarwal. He is a startup investor and an invest strategist. Mr. Nitesh Aggarwal is an alumni of IIM Bangalore from the class of 2006. And over the years, he has donned the hat as an investor and as an enabler of investment. He has been, he had played a primary role in merger and acquisition advisor to L&T Limited. He's managed investment books to the tune of 100 to 250 million US dollars with the funds like Q India Investment Advisor, New Enterprise Associates, and Allegro Corporate Finance. He is director with Fountainhead Ventures, which was merged with Edelweiss VC Fund. Since 2016, he manages his own strategy advisory firm, which has helped 30 plus startups to raise funds and as a strategic advisor. For the last couple of years, Mr. Nitesh is also leading a single family office with 125 million US dollars corpus, investing in early stage tech ventures across US and India, and advises a multi-family offices with $400 million corpus to invest in startups. So I think an amazing, I think we are going to have a deep insight into startup story. So without much ado, I would hand over to Mr. Nitesh Aggarwal. Sir, all yours, please.
Thank you so much. Thank you, Mr. Neville. Thank you, Sanjay. And thank you, Satish. And thank you all the members of BIA for organizing it and giving me this opportunity. So, I mean, we'll keep it informal. If there are any questions, I think, we can, kind of put it on the, kind of chat box. You can pick it up. I have put together a quick deck. I will essentially, kind of share that. So that will be there in the, kind of background. But I mean, we'll, kind of keep it, conversationally, right? So I can start. So so startups have created a lot of wealth, right? And I mean, one of the reasons why we are essentially organizing this event, right, and everybody is essentially looking at it is because, startups have created a lot of wealth. This journey is in India started for the last 10 years, right, 10 to 15 years. And currently there are 44, kind of unicorn startups from India, and, we've, raised, have a valuation of more than $1 billion. And that is essentially, kind of continuing to grow. But it's fundamentally different from, kind of traditional business. And I mean, I'll, explain, kind of how and, what's the difference between the way, traditional businesses are being run and valued and, kind of looked upon versus how a startup is essentially, kind of looked upon, right? So in India, this is the, kind of graph of the overall, kind of funding which India has, invested in startups over the last 4 or 5 years. The number is essentially, kind of grown closer to 60 to 80 billion dollars. And very soon we are essentially going to be, kind of hitting the $100 billion either in this year or the next year. And I mean, very clear pathway of essentially, kind of investing close to like 200 to $500 billion, right, in startups, right? So the startup story is here and, it's there for real, right? So to then continue, just one sec. Yeah. So, what's the difference between, let's say, a new age startup and a traditional startup, right? I mean, the core difference is that, the traditional businesses are run like a profit organization businesses. Most of the, startups are like a winner take all, right? Where there'll only be, let's say, 2 or 3 players who will essentially, kind of win at the end of the race, and everybody else will die in between, right? So think of it as a race, where there's a race where there are only 3 winners, winning only at the end of the race, right? In between, there is no winnings, there's no profit to be made. Only at the end of the race, 3 people will win, right? So think e-commerce, right? Millions of shops, but only 3 startups, right? Amazon, Flipkart, maybe a Snapdeal, right? Taxi aggregation sites, hundreds of them had started off, lakhs of taxis. but only Ola and Uber, right? So there are only few winners at the end of the race. So think of it as a race, right? So how do you invest in startup? Think of it as a race in the beginning, and only 2 or 3 winners will be there at the end of the race. And the idea is to pick who those 2 or 3 winners will be, right? So what's the funnel in India, right? I mean, there are a total of 1.9 lakh startups in India, of startups which are funded, right? Let's call it, kind of early stage funding, right? 100K to a mil. There are only 2,000 of them. So only 10% of them, close to, have got, kind of that level of funding. A mid-stage startup, let's say, kind of $1 to $10 million, only 4,000 of them. So you're down to 2% of them, right? A growth stage startup, which is, kind of raised between 10 to $100 million, is only, let's say, 1,000, which is, kind of 0.52. And more than, kind of $100 million dollar funded is only 344 of them, right? So it's a very small amount of startups which are going to be there at the kind of end of the funnel. But if the founder kind of continues there at the end of the funnel, it will essentially become a unicorn, right? So how do we invest in startups, right? So if the founder stops in between, it's a write-off. The idea to the way to look at it is think of it as a race. We have to kind of figure out at all points of the race who is going to kind of win at the end of the race. So to quote Mr. Larry Ellison, we have to see things in the present, how they will kind of appear to us in the future, right? So there are 3 parts to the question. One is essentially, how do you choose which race to bet on? Because there are multiple races, right? There's a taxi aggregation race, right, going on, which is played by, let's say, Ola, Uber, right? There's an e-commerce race, which is played by Flipkart and Amazon, right? So which race will you choose to bet on? Who do you choose to, right? Which horse do you choose to, right, to bet on, right? Which of the companies will you choose to bet on? And second is, which stage of the race would you like to enter, right, to bet on, right? So these are the broad 3 questions, right? So the first one, right? So traditional investor thinking is, okay, let's understand which sector, and that will essentially pretty much determine what I should invest in, right? But in there's an underlying belief that each and every sector will get tech enabled at some point in time. So sector to that extent is not very relevant, because each and every sector will get kind of tech enabled, right? So what do we look at when we are essentially figuring out which race to be on? First one is that the market size has to be large, right? So think of it as the whichever startup is running the race, at the end of the race, the winning has to be large, right? So the market size has to be large, right? So e-commerce, the Flipkarts and Amazon are taking share away from the shopkeepers, right? So the overall retail industry is fairly large. That's what kind of size of the market is, right? So each startup is essentially going after some size of the market, and that size of the market has to be really large. So that's essentially kind of the first key. The second one is there has to be no large obvious competitor, right? Way back in 2015, whenever people are essentially investing, they will look at what's happening in the US. So there's a Groupon, then they say, okay, yes, let's just copy the code of Groupon and essentially launch something in India. A clear recipe for a disaster, right? Because if, let's say, we are investing in a startup which is beginning the race right now, running on a cycle, and there's a large funded player which is running in a Lamborghini, there is just no way that our startup will be able to ever catch up with the larger guy, right? The third one is let's apply the 2030 lens, right, and backwards, right? So how does the world look like in 2030, and figure out whether this app will exist then or not, right? The analogy being, okay, we are kind of betting on a race where the race organizers themselves run away, right? There's no prize money left, right? So now, for example, let's say there's an app which helps get you drivers, right, on demand, right? Uber like app, you can go to an app and essentially get the driver, right? I mean, but if I, let's say, crystal gaze from 2030 and backwards, would this app exist? Because maybe by then there'll be driverless cars, right? And the most important question when kind of looking at which race to bet on is, why now? What has changed about this sector now, which has made it really interesting to invest in, right? And I'll give you a couple of examples, right? So smartphones happened, there's an entire app revolution, right? Ola happened, Uber happened, Flipkart happened, all of these guys happened. Those are common names which we kind of understand them now, right? So why now? Every startup, there is a right time. There is some bottleneck which is solved, and as soon as that bottleneck is solved, then the next solution can essentially emerge, right? So genetics are being mapped. Only then can gene therapy come out, right? EVs are, kind of taking off right now, right? And only then a startup which is essentially saying, okay, so I'm going to replace the graphite in the battery because, the world is going to run out of graphite by tin, some innovators come out with it, right? That can only happen once EVs are taking off, right? Only when wearables are coming in, can remote monitoring platforms can essentially exist, right? So there is a bottleneck which is being solved in the world, which will then essentially, allow the next phase of startups to come in, right? Because at all points in time across the world, the billions of us are essentially kind of thinking at every day, how do we, kind of solve for something, right? So an idea which could have existed 10 years back, too late. And if let's say the solution does not exist, there's a very real reason why it's not existing right now. And there are solutions which are slightly early, which can only happen once that solution is figured out, right? So very, very key important part to look at is why now, right? So to just kind of very quickly summarize, right? Market size has to be large. There shouldn't be any large obvious competitor. The sector should exist in large size by by 2030, at least the next decade as well. And most importantly, something in the world should have got solved now for this sector to suddenly emerge as the new growth engine, right? So those are the four things to look at when we are selecting which race to bet on. After we have decided which race to bet on, we have to decide which race within the, which horse within the race to bet on, right? So in real estate, it said that it's location, location, location. In startup, it's founder, 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 right? You pretty much kind of betting on the founder, right? So the next obvious question is, okay, how do you decide on the founder? So Neville, if it's possible to unmute, you can unmute everybody. A quick trivia. We all know YouTube. What was the original idea of YouTube? How did YouTube start off as? Hello?
Yeah. I have unmuted everyone. Like they can unmute themselves now.
Yeah,
Sure.
Video sharing. I guess.
No.
I guess so.
No, not video sharing. Anybody else?
Or publishing themselves. I think that's what the YouTube thing was. They used to call it democratizing publishing. I don't know, that was the word which I heard back in 2006, I believe.
But that's not how they started as well, right? Those are all,
It was,
jargon. Yeah.
Sorry, I think it was a dating service or a dating sort of website or app for sharing like videos to find prospective dates.
Absolutely. So it's the right answer, right? So YouTube started as a dating website, right? So the idea at that point, the way the founders are thinking, and I mean, incidentally, they started it on Valentine's Day, right? So they were struggling to find dates. Okay, how do we get dates? And that's how they started YouTube, right? Out of garage. So how do you find dates? They said, okay, just by looking at the picture, it's not good enough. Let me figure out a tech which will enable me to record my video, send a link to somebody and host it in the cloud, right? Send the link to somebody and the other person click on the link and essentially see it, right? If you really think about it, that's exactly what YouTube is. Just the application layer on top of that was that of a dating website. So they struggled, went nowhere. One day they just decided to kind of remove the application layer on top of it, launched it, went for a holiday, came back, and the servers had crashed, right? Because suddenly, every mother was sending their child's photo because a child's video, right? Because at the core essence, it was whatever it is, right? So the idea can morph and pivot, but founders are the only constant, right? So we are pretty much kind of betting on the founder. That's the key, right? And I mean, there's an entrepreneur in actually all of us, right? So we are entrepreneurs because there's something genetically coded in us to essentially, kind of think of what we can, kind of do next. So what is it that we can look at who is the right founder? First of all, is the person with the right domain knowledge. So it can't be so let's say it's a biotech startup, it has to have a biotech founder, right? It can't be, somebody from I'm Bangalore doing his MBA, hired a biotech founder, giving him some salary and essentially starting it. If the biotech engineer leaves, the investor will also not know what to do. I will also not know what to do, right? And the company shut down, right? So it has to be a founder with the right domain knowledge. Whatever it is that the startup is trying to do, they have to have that domain knowledge to lead that business. Second is they have to have the ability to attract and build a large team, right? Gone are the days when essentially.
1 minute. I just wanted to understand the same screen is there. The first screen. Are you shifting the screens because we are
Actually,
not?
I am.
So I think there is some issue because I think all of us can see the first screen only, right?
Sorry, one sec. I'll just stop share and share again.
Yeah.
What can you see now?
Yeah. What is look? Yeah. Right founder. Yeah.
Yeah. Okay. Yeah. So now what to look for in the right founder, right? So first one is the right domain knowledge. It has to be whatever startup it is, right? If it's a biotech startup, it's that. If it's a semiconductor startup, it has to be run by people who understand semiconductors, right? Second one is ability to attract and build a large team. Gone are the days when we'll be able to kind of just hire employees and say, okay, just because we are paying them salary, they're doing what they're supposed to, right? So they don't need to be micromanaged anymore. They need to be micro inspired. So and I mean, if let's say you take, and I'll give you a couple of examples, right? So let's say it's a blockchain startup in the US. One of the most difficult tasks for them is to essentially get blockchain coders. Any of the blockchain coders have been kind of investing in cryptos way back from 2010 15. They're all kind of multi-million dollars just by the amount of cryptos they're holding. There is no way a manager is essentially kind of going to the employee and saying, okay, do this. Literally in the US, you have to go to the employee, tell them, okay, this is what we need. Are you interested in doing it? And the guy actually has every right to just say, okay, no, this doesn't interest me, and he'll not do it. So the ability to attract and build a large team, especially of coders, especially of people, of knowledge workers who can essentially come together as a team with a common vision, is a very difficult skill. Not everybody has it, and that's one of the most important skill set. Third one is somebody who can persevere through the ups and downs, right? The startup fails and shuts down the minute the founder walks away, right? And with the first 5 years of the journey is extremely painful, extremely lonely, and there's amount of perseverance a person needs to have to go through the ups and downs is tremendous. So the person who can essentially persevere, and that can only happen if there's a very strong sense of why is he doing it. The fourth one is essentially ability to build tech at scale, right? A solution which works with 10 users is very different from the one which will work with 1 million users. Fifth is great clarity in terms of what's the go-to-market strategy. And the last one is it needs to have the necessary skill in the game, right? Again, I mean, there are multiple businessmen who've tried doing this. They'll hire some developers. They're continuing to run their own business, want to create this as a side business. And I mean, sure, recipe for death, right? The founders have to have significant skin in the game. The first round, they should have, raised from their friends and family. So they should essentially have, kind of bet, if not their own money, if they can't, at least the, kind of money of their friends and family, right? And they should have a significant, stake at the cap table. So that they're aligned to the kind of final outcome, right? The next one is essentially kind of who wins the race, right? Who wins any race is not a person who's slightly ahead, but who's running faster. The equivalent of speed in a startup is the month-on-month growth rate, right? Now, we've all heard of, let's say, YC, which is an incubator. Yes, Kaustubh.
Yeah, hi. I have a question around the ability to build tech at scale.
Yep.
So how does somebody who is a non-techie but who has a great idea, so how do people who are at a startup stage go around doing it? Because I see this as a hurdle. I've experienced it myself. I've seen several friends who have great ideas are still struggling to understand how do they go about it.
It's a good question, not an easy answer, right? Because I think the talent crunch is very huge globally, because I mean, tech is eating the world, right? So nearly everybody wants to essentially start something in tech. And to give you a couple of random statistics, right? Starting from the US, 330 million population, 140 million people work. 4.5 million are coders. The shortfall of coders is 1.5 million. And all the coders which the entire all the US universities, including all the H1B exports we are doing from India, is only 400,000, right? So everybody wants tech talent, right? I mean, how do you solve for it? It's not an easy answer at all. Most of the well-funded startups are very clear, right? I mean, if they want a CTO, his current salary 60 lakhs, the Sequoias of the world are saying, okay, just pay him 80 lakhs and kind of get him on board, right? So again, not an easy answer. especially somebody who's not in the tech ecosystem. And if it's a tech-based startup, it's, I think, a much more difficult thing. One thing which could possibly be done is essentially also choosing stacks which are more prevalent right now, which have got more developers in the kind of entire ecosystem, right? So maybe a a JavaScript stack is essentially kind of better to choose than, let's say, a Java stack, or let's say a Flutter stack, right? So choosing the right stack which has got kind of more people on the ground, at least getting some people, some strong CTO who can essentially then kind of organize the rest of it, would be the kind of right way of going about it. But it's a very difficult question. I mean, there's no really very clear answer there.
Okay, thank you.
Sure. Sorry. One is the founder, and second, I mean, the other thing to look at is essentially, what speed at which he's running the race, right? So the equivalent of speed is month-on-month growth rate. We all know Y Combinator, one of the kind of very popular incubators in the US. As soon as their startups come out, the expectation for the founder is 5 to 7% week-on-week growth of some metric. That metric need not be revenue metric, right? It could be just any metric. It could be monthly active users. It could be daily active users. It could be, let's say there's a startup called Apna, right? Number of interviews they're doing month on month, right? So any metric, right? So the founder said, okay, choose a metric and just go month on month on that metric. At a slightly, kind of growth stage, essentially it starts tapering down. A sub 6%, right? A month on month growth rate, which essentially translates to 3x growth rate year on year, is like a kiss of death. No well-known VC will touch a startup if, let's say, kind of they are kind of doing lower than that, right? So the mantra is, okay, tum mujhe growth do and main tumhe funding dunga, right? So it has to be, I mean, take a metric, just now push the pedal and just keep on kind of jumping as much as you can. Very interestingly, when funds do it, I mean, this is not practical from our perspective, but when funds do it, they actually, I mean, a lot of funds, and I won't take any names, they actually do a psychometric study as well. So they will, let's say, kind of do a psychometric study called MBTI, and I mean, there is one ENTJ-A. Those are maybe only possibly 3% of the total population type, right? If, let's say, the founder is not that type, they won't take them. The other popular method they do is background check, where they just get some people to follow the founder, right? From his home, the person will be standing downstairs, and they'll follow him and see where it goes, and reports at the end of the day. For extremely larger transactions, they will do a very detailed kind of check, right? Both education background, financial background, etc., so on and so forth. Not practical from our point of view, but I mean, that's what is done, right? So what is the other metric which people are kind of looking to figure out who is the right founder? Right. So again, going back to the race analogy, if, let's say, a race is about to start and there are 10 people running in the race, you know that one of them has run before, right? Some of the race he's run and he has won that race. So the probability that you bet on him is going to be much higher. So that's a returning founder phenomena which is happening in India. To give an example, right? Taxi for Sure guy starts a startup. The first day he gets a check from Axel, and I think Tiger wrote the check for $10 million or a $40 million check, right? When he thought of the idea, right? So the founders, when they're starting their second innings, is another journey. All the check boxes met, right? All of these 6 check box. He has the domain knowledge. He can build the team, will persevere through the ups and downs, can build tech, right? Can sell, so on and so forth, right? All of it is met, right? So a returning founder, when he comes back, most of the VCs are just rewarding him with a large check right at the very beginning. Problem is, how do you find these returning founders? Extremely difficult, but they will, the more blue-blooded that founder is, he'll typically go to the Axel and Sequoias first before he'll go to anybody else. The second one is, of course, kind of a deep tech founder, right? I mean, somebody who's got some extremely deep domain knowledge in one particular thing, multi PhD, multiple such founders coming together, right? They will definitely kind of solve for something, right? So third one, I mean, people have a metric of how many founders should be there in the unicorn. So in a company, in unicorns, it's typically 2.2. I'm not a very great fan of thumb rule, but I mean, I prefer at least 2 or 3 founders, because it's a very, very lonely journey, right? So if it's only a single founder, then there's a problem, right? And the last one is essentially, I mean, extremely important to get references, get kind of background checks, etc., so on and so forth, to kind of bet who the right founder is, right? So what we're looking for the founder is very clear. How do we figure that out is extremely subjective, and depends on how that conversation is going. Then the next one is essentially, okay, which race do you start on, right? When do you, which phase of the race do we look at, right? Do we look at the very early stage? So that's like just before the race has started, at the seed stage. Then second is early stage, right? After the first few laps. Then mid stage where, where 75% of the race is over, and late stage where like practically 10% of the race is remaining, right? So during the seed stage, after validating all the obvious ones, right? That 2030 rule, no obvious large competition, large market size, why now, right? The only bet is on the founder. At the very early stages, if it's after the first few laps, the company has got some metric, and the way to do it is essentially check on month-on-month growth rate, and that's the metric to bet on, right? So if let's say they're a year old, pick any metric, right, and see what's been the growth rate of that metric for the last 12 months. If it's making sense, if they're growing at let's say 10-20%, then it makes sense. If it's been flattish, a lot of founders say, okay, yes, once you give me marketing dollars, I'll then spend marketing dollars, attract customers, and get the traction. Very rarely will they ever be able to kind of do that. The third one is mid-race, right? So mid-race from a VC analogy is where some of the blue-blooded VCs will already be in, right? So Bloom, Sequoia, Axel, Nexus, etc. One of them will already be in, right? The metric phase chase continues, right? So they are the VCs are still asking them to kind of chase this metric, very in a very rapid fashion. But the founder is large enough where he's not going to deal with small guys and share any data, right? So the best bet there is to essentially possibly get a secondary as a bridge between two rounds, right? And the way it's typically done is discount to the next round with the floor of that previous round, right? Late stage will be, let's say it's like a pre-IPO, right? Mortality risk is like near zero. Very large funds have already entered. The only thing to be checked, at least, I mean, what I would do is what is the headroom for growth, right? And I mean, I didn't want to take names, but I mean, just to kind of make it, a little bit real here. So let's say if I remove electric cars and all that, whatever the other things which Ola is getting into, whoever is wanting to use Ola is, let's say, using it, right? But if I, let's say, take Policybazaar on the other hand, the insurance penetration itself is just 4%. The digital penetration itself is the kind of sub 10%, right? So the headroom for growth, yeah.
Sorry, one second. I think the PPT is again freezed. Can you just
I'm so sorry.
Yeah,
so where did I lose you? Okay. So again, so 4 stages, right? So what stage do we come in, right? Before the race has started, seed stage. So the only bet is on the founder. After the first few laps, where the large blue-blooded VCs have not come in, the only thing to be checked is what is the month-on-month growth rate, right? And what growth is the founder growing at? And it could be any metric, need not be revenue metric. In most cases, it will not be a revenue metric. The third one is mid-race, where some of the large blue-blooded VCs have already come in, right? So the way to do it would be essentially kind of come in as a bridge between two rounds, which is essentially kind of offered by a lot of platforms. So it typically happens at a discount to the next round of the floor to the previous round. And at the late stage is where pretty much the risk of mortality is like near zero, right? I mean, Ola is not going to shut down, right? Or Byju's is not going to shut down, right? But the only thing which I would typically check is what's the headroom for growth from here, right? So like a Policybazaar for me, again, I'm not suggesting any, giving any investment suggestions, but I mean, I'm just sharing my view. Insurance penetration itself is very low. Internet penetration is very low. So there's a huge headroom for growth, much more than, kind of possibly other place. Right. So that's the, kind of, the way where, what stage, somebody needs to come in. I'm sure the question which is gnawing you most is, okay, how do you value the startups? Right. That is possibly the most important question in your mind, but it's possibly the least important question when you're figuring out startups. Right? Because if a founder shuts down and you have 50% of the company, your value is zero. If you have 30% of the company, also zero, and 10% of the company is also zero, right? Because if the founder shuts down, it's zero. If not, he's a unicorn, right? So gauging mortality is far more important than how do you value the companies, right? So that was what we essentially, kind of talked about. How do you gauge whether the startup will, kind of remain a race, right? Who will win the race? That's what we're trying to figure out. Having said that, I mean, finally, we still, kind of need to, kind of value the company, right? So again, very different ways it will happen in, kind of all the 4 stages. So valuation at seed stage, is it high valuation? Possibly yes. The typical metric is EV to invested capital of 3x to 7x. So if somebody is investing $1 million, the valuation of the company is $3 million, right? If somebody, or let's say $7 million. So more capital efficient founders are rewarded with higher multiples. Seems completely counterintuitive, right? The more money you put in, the more is the value of the founder. I mean, how does that make sense, right? But broadly, this is to ensure that the founders have skin in the game. And again, the investors' shares at this point in time, while it will notionally be worth $3 million, is actually worthless. Nobody's going to buy a secondary. If he's shutting down and moving away, nobody's giving him anything. And investor shares have typically, they come in the form of convertible preference shares, which will have liquidation preference. That if the company shuts down, if they have invested $1 million, they'll get $2 million first before the founder can get anything, right? They will have anti-dilution right. If the next round happens at a lower valuation, the founder will need to give them more stakes so that they get compensated. They'll have more MFNs or most favored nation clauses. If the founder is giving stake to anybody subsequently at a better rights, then that needs to be kind of given to the current thing, right? So a very preferred, very simple kind of instrument are called safe notes. Safe notes are like a convertible instrument, which will happen at a discount to the next round with a cap. So if the next round happens at whatever it happens, at least the early stage guys come in at a lower valuation for sure. And there's a cap. So there's a huge upside as well, right? So a cap of, let's say, $3 million in the, if let's say somebody is investing $1 million, the cap will be $3 million with a discount to the next round, right? At the early stage, it essentially starts moving to EV to revenue, because I mean, there the revenue kind of starts kind of coming in, right? So it ranges anywhere between, let's say, 2x to 25x, but I mean, medianish would be kind of more 9 to 11x. Of course, it depends on which sector it's essentially kind of looked at. And again, within that sector, I mean, what's the growth rate at which the company is growing, right? Higher the growth rate, the more is the value, right? I think credit is valued at, I think, some 250x or something of revenue, right? So I mean, it could be really very high depending on whatever growth rate the company is going at. The third one is mid stage, right? Mid stage is where VCs have already come in. Typical pricing is 15 to 20% discount in the next round. If no further round happens in 12 to 18 months, then whatever is the previous round, right? So if Sequoia has already come in at $5 million valuation, then that's the valuation at which you will be able to come in if there's no further round, right? And during late stage is pretty much, the pricing is whatever it is. You'll have absolutely just zero latitude to change the pricing. If let's say somebody like a SoftBank has already come in and you're getting a small secondary pool from somewhere, it's pretty much, price is something which you can't dictate. Sorry?
Oh.
Right. Okay. Then coming to the next topic, right? I mean, how do you decide, right? So in any decent fund would typically invest in 1 or 2% of the deals which come through, right? So Anderson Horowitz, I think it's around 0.7%, right? Most of the funds would, if let's say they look at 1,000 funds, they'll essentially invest in 100 to 10 or 20, right? So first of all, this has to interest you. You need to start, enjoying speaking to founders, listening to the story, have the time and bandwidth, right? And then a couple of, some other first principles, right? Don't decide at the first go. At least look at the proposal some 2 or 3 times, right? So if a very beautiful lady has smiled at me during a breakfast one day, all the proposals that day, I'll kind of be, all of them are proceed. Or if let's say I have a fight with my wife in the previous day, then all of them will be declined, right? So, have to make sure that we are not biased by our moods. So, first principle, don't decide in one go ever. Look at it 2 or 3 times and essentially then do it. And then, I mean, of course, the more structured you can get, the way we look at it is a staged decision making. So at the deck stage, we review this deck, and if the space interests us, which is, no large funded startup, large market size, etc., we'll essentially kind of do a go no go, right? So it's a 50% decline rate typically. Then the second stage is where we'll do a call with the founder one-on-one or recording, and then we'll ask questions and then we'll discuss, and then we'll do our research. Then essentially that'll be the second stage, where again there'll be no go, and typically 30% would kind of proceed after this. Typically, there will be a subject matter expertise, right, required for something, right? If it's an insurance startup, then speak to somebody in insurance. If it's a health tech startup, speak to somebody in health tech, right, and get advice, right? But the only point I would like to make here is that don't take advice from someone who has not been in the startup ecosystem, right? Because they'll not know how to metricize that person at all, right? So you're not get any kind of valuable feedback. And if let's say it passes all these 3 stages in the funnel, then you will spend more time doing a very detailed study around if let's say 1,000 100 are you're seeing 100 proposals in a month, then you will do detailed study around let's say 2 or 5 of them, right, where you will validate the valuation, founder's edge among others, validate the growth rate after we shared the MIS, validate the market size, right, so on and so forth. The next question is, given that mortality is given, right, diversification is key, right? So do not invest in startups if let's say you're only looking to invest in 1 or 2 startups. It'll be a pure recipe for disaster. So there's a study, and I think this is slightly dated, for 2004 to 13 period. Correlation Ventures, which is a fairly well-reputed body, had kind of conducted the study. Out of 20,000 financing rounds, 2/3 of them, nearly 2/3 of them shut down, right, or 0 to 1x return. But on the other hand, 0.4% of entire financing rounds gave a 50x return, right? So 2/3 of them still gave less than what the amount of money which was invested in, right? So diversification is key. If somebody doesn't diversify, very likely that essentially is coming to the left-hand side of the pool, this curve, as opposed to the right-hand side of the curve, right? So in terms of diversification, if let's say very, very early, if somebody is kind of looking at writing very, very small checks, coming in really very early during seed stage, I mean, I would suggest at least do a 50 to 100 kind of startups, right? That's the kind of diversification you will require. And then approach that with a very low touch strategy, right? Then you put in the money and then forget it, right? Whatever the founder wants to do. Early stage, anywhere between let's say 20 to 50. Mid to late stage, the diversification should be in at least 20 startups. Extremely late stage, then maybe you can kind of do 10 startups, right? But mid stage, it has to be high touch, right? Where you are essentially going to the founder and the promoter and saying, okay, what can I do for you? How can I help you grow as well? Right. So there is mortality. So what has the fund still returned, right? So what is this asset class returned in terms of IRRs? So 6,000 funds, from PitchBook, right? So the data point is that the top quartile has returned anywhere between 19 to 777%. Second quartile has returned anywhere between 12 to 19%. Third quartile has returned anywhere between 7.5 to 12, and the fourth quartile has actually done minus 8.5. So the minus is missing. So they've actually lost money. So minus 8.5 to 7.5%, right? But if you're doing yourself, if you're let's say kind of following some methodology, very likely that you will be in the top quartile, and so target should be around 20 to 25% annualized return from this asset class. Right. So I mean, I'll just kind of more or less kind of end with this, right? So investing, for me, this asset class, which is investing in unlisted early stage tech companies, is possibly the best asset class for the next decade, right? The VC ecosystem and the founder ecosystem has become much better than they were earlier. Founders are not coming up with me too ideas; they're coming up with very specific, niches which they're trying to kind of go after. VCs have become a lot better in understanding, and also we have got a lot more VCs now. In 2015, maybe there were 15 to 20, VCs which are there. Now there are, I think, 700 plus micro VCs which are functioning in the market. In the US, there are like some 10 to 50,000 VCs which are there in the US. So funding is available. So again, we're trying to take care of mortality. Earlier, there were good, companies, very good founders, and they were still dying, right, because of lack of funding, right? But now, given that we have enough capital, who are hungry for good companies, so funding availabilities, at least so that the better ones, is not becoming too much of a challenge. Thirdly, earlier, if the company was shutting down, they were just shutting it down because, I mean, what else could you do? Now they are getting bought out. They're getting acqui-hired, they're getting acquired, there is share swap, there are multiple ways in which it's happening. Earlier, there was just maybe, kind of 2 unicorns, which could possibly acquire. Now there are like, hundreds of unicorns, monicorns, and soonicorns who are available to essentially acquire somebody, right? What do they get? They have, some business vertical which needs to be, kind of led. They get a founder who's very hungry, who's very, I mean, that's his why, that's what he wants to do in life. So if it's a Byju's is essentially acquiring all the other edtech companies, rather than them starting a vertical and hiring a CEO, paying them salary, rather than that, it's much better to acquire a company where the founder wants to do exactly that, right? And he's good at that. And he's shown that by, kind of running his own company. Fourthly, Earlier, exits were not happening. People were investing. It's a 5-year journey. You put in money and there's no liquidity after that. But now exits have started to happen. In fact, it's become far more regular. In fact, to the extent where early stage investors are not liking it, right? Because the late stage or even mid-staged investors, when they're coming in, they are edging out, right? They are saying, okay, yes, let's give an exit to all the other investors, and then the founder essentially requests for the early investors to get out. So exits are happening, and possibly more earlier than what early stage investors want it to be. And lastly, I mean, there are IPOs happening, right? So going forward, I'm pretty sure that in the next 5 to 10 years, out of Nifty 50, at least 45 of them will come from kind of the technology domain, right? So pretty much that's where we are. So ready your wallets and grab the startups, right? So that's from me. Happy to take any questions, and we can take it from there.
Yeah, I have unmuted everyone, so we can have questions in the chat also, and you can ask directly to Mr. Nitesh Aggarwal. You can unmute yourself and ask questions.
Dr. Gautam Kulsi has a question, I believe.
Dr. Gautam, you can unmute yourself.
Any questions?
Yeah, I have a question. I wanted to. I was that valuation thing is something which Can you just explain exactly, because you went a little fast out there?
Sorry,
Not able to cop up with that. So
understood. Sure.
Because that is the most important thing which most of us would like to understand. Yeah.
Correct. Okay. So let me just kind of go through the kind of valuation again, right? So the 4 stages again, right? So the company is just about to start, right? So when the company is just about to start, or they don't have any metric whatsoever, right? You're pretty much kind of seeding the company. At that time, the valuation, if let's say you put in $1 million, the valuation of the company is $3 million or $4 million, right? So you have to ensure that the founder has 15 to 20%, investor only has 15 to 20% of the stake. The balance is with the founder, right? So by that logic, if let's say you put in $5 million, the valuation of the company is $25 million, right? So valuation is 4x of whatever amount of money you put in during the early stage, right? And this is extremely counterintuitive, right? I mean, the amount of money you are putting is determining how much value the company should have. Right. Seems extremely counterintuitive, seems extremely stupid, but the reason for doing so is by the Series B, the founders at least have to have 30% stake, right, or 40% stake. None of the larger VCs will touch it if these founders have less than that. The same thing can happen even to Paytm as well, right, where Vijay Shekhar Sharma actually had to go to the previous investors and say, okay, give me back the stake, right? Otherwise, I'm not getting money. But if you do, I'll get money, right? So whether you take higher stake initially or not doesn't matter, right? The late stage VCs will come in, force you to give up your stake to the founder later on. So one way or the other, the founder will essentially kind of have that kind of stake, right? So at the very early stage, the metric people are looking at EV over cumulative invested capital. And to give a completely different perspective, right? By the time a company is a unicorn, the average amount of funding which the company requires, the total amount of funding which is required by that time is around $231 million, right? So approximately 4x or 5x of what is the amount of money which has gone into the startup is what value it's able to kind of create, right? So people pretty much kind of take the same metric. It could be slightly higher earlier on if it's more capital efficient. But broadly, I mean, that's the metric which people are looking at, right? What is the total EV to invested capital? There is no other metric. Slightly later on, once it grows even a little bit, let's say it grows, 2 year, 1 year into the journey, it will start having some metrics, right? So even if it doesn't have revenue, then maybe, by the second year, it's supposed to have revenue. Then you look at 1 year forward revenue and then give a multiple on that. The multiple on revenue is anywhere between, broadly around 10x, 12x, sometimes 20x as well. Now, what is the so the metric to look at is revenue and give a multiple on that once the company is in a slightly evolved stage, and there the multiple is higher if the growth rate is higher, right? So just to repeat myself.
Yeah, one can look at revenue. One can also look at LTV of the potential customers or of customers which would come in future.
Correct. So Satish, that becomes a slightly more difficult task, right? Revenue,
Yes.
I mean, people find it more difficult to calculate revenue, to calculate LTVs and all that. Typically, non-investment proportional, professional guys, very difficult for them to start computing it, right? You have to, how do you compute the LTV? How do you get the cohort? How do you get the data? I mean, it's not an easy task there.
Yeah, but then that's another good metric to follow when you are valuing a company.
Correct. So that's the second stage, right? Once the company has started to kind of produce some numbers initially, and the really none of the famous VCs have essentially kind of come in. That's how you would value it. The third stage is when one of these guys have already entered, right? So let's say Axel has already entered the company at a $40 million valuation, right? So the valuation has already been determined. Now we can't question this anymore. I mean, you can't go to Axel and say, okay, it has to be lower. Next round would typically be, let's say, $100 million valuation, right? Because it's doing a 2x or a 3x year on year. So a lot of people have started doing bridges between these rounds, saying, okay, yes, we'll come in right now. It will be, let's say, a 20% discount to the next round. If the founder does not raise within 12 months, he'll go back to the same valuation at which Axel has come in, right? So at least so you're protected. And the fourth one is where it's late stage, right? Where, let's say, SoftBank has already come in, or Paytm price is, let's say, 1,800 rupees per share, right? So it is what it is, right? So very difficult to. So you already, I mean, the only way to do it is just figure out where the large guys have come in. If there's some secondary pool available, it's slightly cheaper, or maybe at the same price, then try to get that allocation. Does that answer your question?
Yes. It still needs this thing, but I think the way it has been looked at the early stage, and it is completely different when it becomes revenue based only after certain stage.
That's correct. Yes. So at the early stage, it's just making sure that the founder is aligned, right? The founder has enough skin in the game. First round, all the investors put together should not have more than 15-20%, right? And I mean, I was also pointing out that, so let's say you put in $1 million and the founders have, the company is now valued at $5 million. So the value of the founder, is $4 million, but it's actually zero because the founder can't sell it, right? And the founder's equity is much more junior than the investor's equity.
Right. So most of the time you negotiate and say you want higher stake at lower price is not a sensible thing.
That's correct. And I mean, I'm saying that there are enough cases when even that has happened. The late stage VCs have asked the founder to go back to their previous investors and get more stake back, right? And that has happened. The only ones which are successful is where the investors have given the stake back, right, to the founder.
Right.
Yeah. So, Nitesh, this is Amit here. I had one question, and thanks so much for the insightful session. So, do you think startup is a fad in a bubble and it's here to stay, or everything will just blow up? And given that we have already seen the likes of Paytm shares fall like a pack of cards, given that Macquarie report was out, and most of the unicorns in India are nowhere close to even profitability, right? So
Sure. Okay, good. So good questions again, possibly kind of same one, right? I mean, I'll just answer the question in a different way, right? So I'll just kind of so let me just quote Einstein, right? So Einstein said you can kind of live world in two ways. One, by thinking that nothing is a miracle because science is solved for everything. or second is that everything is a miracle, right? Because whatever, because gravity, it's whatever equation v is equal to u plus at, why is it not v square is equal to u square plus at, right? So you can live your life thinking that everything is a miracle, right? So it's finally a core belief. So you can live life now thinking that, startup is a fad, it's all going to blow up, right? It's a belief, right? Or you can believe that, we are doing something which is meaningful, right? I think Indian founders are there. 10 years back or whatever, 30 years back, Infosys and TCS and all this had happened, right? So we did the first step in the IT revolution where we were doing services, but we were getting low-end job. Even 5-10 years back, if a startup would have said that they'll go and sell enterprise software to the US, they would be laughed off, right? There wouldn't be any buyers, right? But now we have the likes of Zoho, the likes of Freshwork, amazing, kind of SaaS kind of startups which are coming out of Chennai, and there is nobody in US who's kind of blinking an eyelid. Our startups are kind of as good in terms of quality, in terms of everything as kind of any other startup which is there. We're not there in terms of deep tech, but I think in the future we'll essentially kind of get there in terms of deep tech as well. So finally, end of the day, it's a belief. Paytm shares kind of went down, it kind of came up again. That's the volatility kind of the market. What you cannot take away is that VSS still kind of created a unicorn, right, of the value it's created, right? Maybe it kind of shaved up $1 million and went back up the next day. But that, in my mind, does not take away the small time volatility, does not take away the inherent value which all the startups are creating in India for the world. So I see some question around, what are the sectors which are good for investing? So again, I'll just give answers basis my judgment, and anybody, everybody will have their own personal kind of judgment and preference. So anything on the artificial meat or dairy, right? Something like Impossible Foods. There's also listed kind of player in the US which is doing it. Another theme which I really like is around aging, right? We're going to age overall as the entire kind of globe. We're going to age a lot. So something like home care, where home care is provided, nursing is provided at home. Third one is essentially at-home diagnostics with remote monitoring. Wouldn't have happened before devices came on. I think devices proliferation is essentially kind of happening in the US and start happening in India as well, which will enable us to kind of remote monitor, where the platform will come to know the chances that you're going to get a heart attack way before you know that you're going to get a heart attack. Next one is essentially precision medicine. So that will follow genetics, right? Once we have genetics, then we'll start coming up with medicines which only work for you, right? So if, let's say, you are suffering from maybe not cold, right, but maybe a slightly kind of serious infection, the medicine which you're going to get is going to be very different from what I get, depending on our genetic makeup. Something on precision insurance, right? So the way you drive the car or the way I drive the car is different, right? So our insurance should be priced different. So I think we'll get there. Anything in the EV space, I think that's the cusp, right? So we are at a cusp where an industry itself is going to grow at 20-30%. Multiple layers within EV, come up with an EV technology itself, come up with the software like battery monitoring softwares. Somebody is coming up with charging stations. Some players are coming up with battery swapping stations. Somebody are coming up with leasing EVs to the Swiggies of the world. Then people are coming up with the core battery technology. Like I said, somebody's coming up with the replacement for graphite by tin by using their own proprietary patented chemistry. Something on skilling, because the way technology is changing, and the way automation is happening, I think everybody needs to be reskilled. Gone are the days where somebody could do an engineering and live their entire 40 years to knowing the same skill. I think we are at a phase where each skill we are learning is only going to be around for 5 to 7 years. So everybody will need to be kind of reskilled again and again. Then anything around NFT platforms. I think a lot of you will say, no, NFT is a fad, which it might be, but platforms which enable people to create NFTs and trade NFTs and drop NFTs. Esports is something which I personally like a lot. Cybersecurity, anything in IoT, overall robotics and automation, gene therapy, gene editing, power electronics, RPA, which is robotic process automation, anything around NLP. Our chatbots will become much smarter. anything in semiconductors like LiDAR on a chip, image recognition on a chip, so on and so forth. If it's a slightly futuristic, kind of verticals could be VTOL, which is vertically, takeoff machines, BCI, which is brain computer interface. So, I mean, there are multiple sectors which are really emerging. The Meta, of course, the Facebook is essentially trying to kind of take over that space. So there are the multiple sectors which are really interesting. So that's something to look at.
And Nitish, there's a query from Mr. Gautam.
Sorry, go on.
Yeah, there's a query from Mr. Gautam, who is into the business of R&D based product development, and his query is, what's the future of lab-based products?
Again, my personal take, I'm actually very, very gung-ho about anything deep tech and R&D. Consumer tech revolution essentially happened after the advent of smartphones, and I think it has happened, right? And then we moved to enterprise tech, and now we are slowly the investor community is moving more towards core deep tech, right? Where the people are coming up with sitting out of labs and coming up with amazing ideas. So I'm extremely gung-ho about the lab-based kind of R&D patented projects coming out of the lab. That's how deep tech has essentially emerged out of the US. We're still not seeing those kind of really good ideas coming out from India as yet. The quality of startups in terms of deep tech is way better in the US, but I think we'll get there. So, and I mean, very gung-ho and very hopeful that this will take off in the future.
The query is from Mr. Kaustubh, whose main query is, unlike a lot of organizations whose, startups who are burning cash, and we also have organizations, large organizations like Infosys, which are, building up an organization of that kind with, the traditional way of business. What's your take on around the knowledge and service-based startups which tie up into megatrends?
I'll take the going back to the winner take all versus non-winner take all, right? So let's assume there's a taxi aggregation service, and the total cost is 100 rupees, right? So as a founder, I have two choices. I can either price the product as 110 rupees or at 90 rupees. All right. So the traditional business would be okay, 110. That's a smart entrepreneur, right? 90 rupees is a stupid entrepreneur, right? But as a consumer, right? If let's say you have taxi aggregation company 1 and taxi aggregation company 2, one is offering at 110 rupees, which is a smart entrepreneur, and another is offering at 90 rupees, which is a dumb entrepreneur, right? All the consumers are going to opt for 90 rupees. The entrepreneur who's offering at 110 rupees will shut down, right? So smart entrepreneurs will shut down. So that's not really smart. So it's a kind of winner take all, right? I mean, there is as much wisdom there as well. And I mean, I'm not sure whether I'm going to be addressing it in the right way, but there is a cost of getting things right, and there's a cost of getting things wrong. In startups, the cost of getting things right is more than cost of getting things wrong. Right, and I'm just going to repeat it, right? The cost of getting things right is more than the cost of getting things wrong. How do you get things right? By essentially, kind of debating, right, among, kind of people who have paid, let's say, crores of rupees of salaries to essentially, kind of get it right. Even if, let's say, there's no consensus driven by them, then, hire McKinsey's and Accentures of the world, spend crores of monies to get the right decision. It makes sense for larger organizations. In the startup, that's the cost of getting it right. But what is the cost of getting things wrong? Hire 5 developers, pay them 2 lakh rupees and just launch the product, right? And the consumers will tell you whether it's right or wrong. So it's in the startup ecosystem is more MVP-ish. Get the minimal viable product, put it out there, hear back from the customers whether it makes sense or not, and then kind of go on refining your product. Finding a product right, a market fit itself is the first phase of most of the startups, right? So so all the startups are burning cash. A winner take all will burn cash. The investor who's betting on Ola will continue to say, okay, sell it at 90 rupees. I want you to get the overall market share, and then we'll kind of kill everybody, and then we'll do it. That's the name of the game. Any winner take all play will mimic that play. It will not mimic the traditional let's make 10 rupees profit out of everything, right? But if you're running a restaurant, you're running a restaurant only feeding them, right? Now, if you're running Swiggy, you're saying, okay, I want to feed the world. There will only be 2 players which will kind of emerge as winners, right? In that. So they will continue to burn cash, but that's not to say that they are not wise, and they will not use the traditional ways of managing growth, because it will be a very ambitious type of growth, right? Do something, put it out there, learn from the customers, refine your product, and kind of rinse repeat, right? So that's how that thing is working. What's my take on services based startups? So again, a very high level question. I'm not able to kind of appreciate what kind of services based, it could, depending on the 4 metrics, right? If let's say it can continue to exist over the next 10 years, if it doesn't compete with anybody really strong, if it has the potential of kind of eating the rest of the world, if it's got really large market size, then it'll still be interesting.
Mukeshji's query on your take on the real estate sector.
So I will choose not to answer the question, because I don't have a take, right? I mean, I'm very focused on this. This is my ikigai. I only look at startups. I've been in this ecosystem for the last 14, actually more than that, 15 years now. Gone through the cycle multiple times. That's the only I was there in private equity first. Now I'm in VC investing, both with slightly different mindset. There was a lot of things which I had to unlearn, but that's the only thing which I could possibly comment on.
So Rajesh has a query. Suppose we invest in Series A at an initial stage. So when should an investor decide to come out of completely? I mean, what's the sign of an investor? How does he look at it?
So when does he exit? Is that the question?
Exit, yes.
Sure. So typically, people exit after, let's say, 2 stages, right? So let's say somebody is coming at a pre-A, they will exit at either B or C, right? Because the next stage, the next investor comes in, and after that, a slightly larger investors come in, right? The valuation is typically, if let's say it's already gone, so the thumb rule, and again, I mean, there'll be a lot of variances to that, is approximately 3x every round, right? So if somebody is coming at a pre-A at a valuation of X, during A it will be, let's say, 3x, during B it will be, let's say, typically kind of 10x from there, right? So the Series B investors typically allow the first stage investors to get out. If the company has not managed to get those 2 rounds and has already been 1 year to 2 year, most likely it will die. So I mean, then you won't be able to get an exit.
So we have another query from Mr. Nilesh, who is already, I believe, an investor at a very nascent stage in a unique service-based startup backed by technology, where currently there are no customers that are paying. How do we? His query is, how do we ensure the true valuation at this stage?
Sure.
At this idea stage.
Understood. So while there is no revenue, is there any other metric you could look at, right? So it's a technology-based startup. So it will still have, let's say you're doing pilots, right? You are essentially putting a machine, I'm just making it up, right? Which is a SaaS-based product, which is allowing, doctors to, kind of do something, right? So how many doctors are using it? How many reports are they creating on a daily basis, right? The metric could be anything, right? So metric is not necessarily a revenue metric, right? So there's a startup called Apna. Again, a returning founder, 3rd-time returning founder, I think got to $1 billion valuation within 1.5 years. 0 revenue right now. Khatabook, 0 revenue, right? So Khatabook, how many people are using it? They're using MAU, monthly active user, as the metric. Apna is using the number of interviews they're conducting, month on month as the metric, right? So what is the metric? As long as you're chasing that metric, right? Facebook wasn't revenue generating for the longest period of time. But what is the monthly active user? How many users were coming on a monthly basis and doing some activity on the portal was the metric which they were chasing, right? So what is the metric which your startup, which you've invested in, you have to identify that startup and make sure that they are essentially, stepping up and essentially kind of doing depending on, how early it is, either a, 10% or a 20% growth rate on a monthly basis on whatever that metric is. A lot of times it's not possible, right? If it's a very large, enterprise sales cycle, then maybe it's not possible, right? But to the extent possible, kind of you can push for that metric to happen. And again, kind of going back to the exit question as well, right? If you think that your founder is not achieving those kind of growth rates and the multiples are becoming flat, please speak to him to essentially try to do a merger with any of the larger players, right? Because you can't do it at the end of the once they've run out of money completely, right? So if they have 2-3 months of money in the bank, So 6-month money in the bank, start, kind of looking at them. If they've, kind of got lower than that, track them very actively. If they got to, kind of 4 or 5 months of money in the bank, request the founder that, okay, let's start the scouting for M&A. Please get acquired. So let's say somebody gets acquired and quicker, you'll get quicker shares, right? For example, right? So, that's how I would, kind of look at it. Again, what's the true valuation? More than the valuation, you are protected by your rights. That he can't give shares at a lower valuation. You have liquidation preference. Liquidation preference is a much more stronger right than the valuation, right? Because valuation could be anything. It's very notional at that time. But if you have, let's say, 2x liquidation preference, if the company gets bought out by somebody, you have put in 1 rupee, you will first make the 2 rupees because before the founder makes even a single rupee, right? So you might have 10% stake in the company. You have invested, let's say, $1 million with a 1.5x liquidation preference, right? The company can get sold for $2 million. So if you have 10% stake, your $2 million is worth $200,000, right? So you should be out of money, right? But you won't be because you have liquidation preference of 1.5x, which means that you will first take the $1.5 million out of the $2 million before the founder is able to take anything. So during the early stage, you will be protected more by your rights as opposed to pure notional valuation, because valuation in the initial stage, it's going to be extremely notional.
Nitish, I have a question. Suppose there are small investors, to the tune of, suppose they want to invest at 20 lakhs, 30 lakhs, 40 lakhs.
Sure.
Small investor. How do you, and they feel, they want to invest in startups. So what do you suggest? What is your advice to them?
Sure. So first of all, rather than doing this in an ad hoc manner, right? And I mean, the reason why I'm strongly suggesting not to do an ad hoc manner, because you have to come up with a kind of a diversification strategy, right? So let's say there are 10 investors, right? Broadly, I mean, there's a soft commitment that they all want to do in whatever, 20 lakhs each, right? So you know that you have a total pool of 2 crores now, right? So figure out a diversification. Now I say, okay, so over the next, let's say 2 years or 3 years, let me invest in 40 startups. I'm just making it up, right? So then you have a figure of, whatever, 2 lakhs, 2 crores divided by, kind of 40 startups, which is, let's say, 5 lakhs. I mean, if I'm doing the math correctly.
Yeah, 5 lakhs.
So let's say it's 5 lakhs, right? So then you say, okay, let me start, kind of investing in 5 lakhs, right? So that's the ticket size. You've established the ticket size. You've established that you want to do 40 transactions broadly over 3 years, right? So which is practically 1 startup a month, right? Because 40 divided by 36 months. So then the next step would be, how do you get 100 transactions or 50 transactions, 100 transactions, where you get access to those pitches? Now that's the difficult question. I mean, the good part is that there are loads of incubators right now. There's Venture Catalyst, there's Jito, there's Let's Ventures, there is Our Ventures, there is I think there's another one. So IPV, Inflection Point Ventures, there are multiple of them which are there. They all kind of in some way get startups and essentially share the kind of pitches to prospective investors. If we're open to looking at globally, then globally there are kind of loads of them, right? Skydeck, there's YC, Y Combinator, there is Techstars, there is Plug and Play. I mean, there's a bunch of them. ERA, which is Entrepreneurs Roundtable, so on and so forth. I mean, there are multiple of incubators out there. So then you start approaching them saying, okay, yes, let me see the startups which are coming to you, right? So firstly, I mean, for a month, I would suggest then don't invest in anything. Just listen to the startups. You start getting a feel of, what kind of pitches are coming, what's the process, what level of information they're able to provide, so on and so forth, right? You start getting that feel. And once you've, kind of have that feel, then, and you've created a funnel of, let's say, kind of 50 opportunities coming, then you need to have a metric, way of figuring out how do you look at selecting the 1 or 2. So you can have like some very quick decision-making thumb rules to, kind of select and reject proposals, and then form out of the 20 people you mentioned, then form like a soft IC, investment committee, who will then take the final decision, right? So the team, whoever is looking at it, can come up with like five opportunities, then they present it to them, and then you select one of them.
Got it.
Is there any incubator fund focusing on Israel biotech? The answer is yes. In fact, there is one which is tied up with the Israeli government, which is essentially, kind of doing, the matching dollar to dollar of what they're doing it. And then they're also tied up with another late stage VC, which is also, kind of investing in them. I am forgetting the name, Mr. Kapil Gandhi. I will definitely, kind of share whatever information I have about them to to you. But I mean, in terms of funds and all that, again, I mean, there is kind of Viola Growth, which is essentially doing fourth, fifth fund. There's a fund called Gleelot Ventures, which has got an IRR of around 74%. Must be in the 6th or 7th cycle. So I mean, there are a bunch of really good funds which are there in Israel, and a bunch of incubators as well, right? So I'll share some information.
Yeah, there are multiple incubators. In fact, we also work with a couple of them in Israel.
Wonderful.
I can share their details.
Any further questions? Yeah, I think you can have, if you have any further questions, you can write to office@biindia.org, and we'll send it to Nitesh, and I think that can be answered. I think, thank you, Niteshji. I'll hand it over to Dr. Rajesh Doshi. I think he'll give the vote of thanks.
Thank you so much.
Thank you, Neville. Niteshji, at the outset, thank you very much for taking the time out and educating us. I think what we have all realized is that there's a lot of unlearning that we have to do before we learn some new things.
Sure.
And beautiful insights and very, very interesting insights that we have got. I'm sure all of us who are here have, I can see some of the comments where everybody is is very thankful for the insight. And I think startups are here to stay. Whether we like it or not, the people who are more into traditional business, we need to rethink and look forward to the change that is coming, the change of the way we look at businesses. So I think it is here to stay. And this is one of our first attempt to bring about that change. And thank you for being that initiator here. And thank you for taking the time out to be here with us. I take this opportunity to thank all the people who have participated, and we can assure you to look forward to more such interactions in the going forward from our side, from BIA. So thank you very much, Neville. Thank you, Sanjay Bhai, for making this happen. Thank you, Satish, for getting Nitesh here, and we look forward to more interesting personalities coming here and helping us in the process of unlearning and learning new things. Thank you very much.
Sure,
Thank you,
Rajesh bhai. Sure.
Yeah.
Thank you. Bye-bye.
Thank you.
Thank you, everyone. Thank you. Bye-bye.
Thank you,
Bye.
Nitesh.
Thank you very much, everybody.
Thanks, everyone. Thank you, Neville. Thank you, Nitesh.
Thank you, Satish. Thank you, Nitesh. Thank you.
Bye.